Hey guys, I'm Big Mike, and like always, I'd like to thank you for being here today. Today we have another webinar from Carley Garner of Carley Trading, talking about option selling with or without insurance. Carley has presented several webinars on BMT that cover options trading, and if you have not seen them already, I do highly recommend them. The webinar is being recorded and will be posted on YouTube sometime later today. If you are watching the recording at a later date and you like it, please do us a favor and give us a thumbs up. It does help us out. Carley said that we can take questions as they come or at the end or a little of both. So if you guys have questions, you can type them into the chat box, the questions box, and we'll get to those the best we can. Okay, guys, give me 1 second. Now I'm going to turn things over to Carley. All right, Carley, it's all yours.
Okay, thanks a lot, Mike. It's a pleasure to be here as always. And I just want to start out letting Mike know we appreciate everything that Big Mike's Trading Forum does for the community. It's a great resource for beginning and experienced traders, and we're happy to be a part of it. Today we're going to talk about option selling with or without insurance. As you already have learned, my name is Carley Garner. I'm with Carley Trading. Carley Trading is located in Las Vegas, Nevada, because quite frankly the weather's better here than it is in Chicago, but we focus on commodity trading, futures and options, which is primarily something you hear about in Chicago. On the West Coast, most people have absolutely no idea what it is we do. Before we get started, I just want to let you know there is a substantial risk of loss, financial loss, I should say, in trading futures and options. It's not suitable for everybody. Past performance is not indicative of future results, and the bottom line is do your own homework. Don't take everything you hear for granted. Make sure you do your research, you understand the risks and the rewards, and you proceed accordingly. If you have any questions or comments or complaints even about the webinar today, you can either shoot me an email or give me a call if you'd like. If you're interested in learning a little more about trading futures and options, we have a lot of educational material on our website, decarleytrading.com, and we also post various let's just say commentary and charts and samples of our newsletters on Facebook and Twitter. So if you're in the social media sphere, check us out. Just a little bit about me before we get started. I'm basically a broker in a nutshell, broker for Carley Trading, but I also analyze the markets a little bit, and some of the information that I publish and put out goes into Stocks and Commodities magazine. I write, I should say, a monthly column in Stocks and Commodities. I've written a couple of books, and I also write for TheStreet.com and various websites in the industry. If you're interested in learning more, these are the books that I've written. A Trader's First Book on Commodities, I've actually written twice. This is the second edition, the blue cover, so if you're interested in that, make sure you get the blue cover. The other two, Commodity Options and Currency Trading, I think as far as the content goes, speaks for themselves. All right, let's get started. Today these are basically an outline of what we're going to talk about. We're going to talk about why you should and also maybe why you should not use credit spreads. It really honestly boils down to a personality choice, and you just have to find what you're more comfortable with and what type of environment is going to give you the best of your ability to make educated decisions. If you're putting too much stress on yourself by taking on too much risk or diving into a strategy that you're just not able to cope with, then you're going to get into trouble. So that's what we're going to kind of talk about today. We're going to define what a credit spread is. We're going to talk about calendar spreads, maybe when they do and when they don't make sense. And we're going to talk about the opportunity costs of these kinds of spreads, because the idea of a spread is basically you're buying insurance against your primary position, and we all know insurance isn't free, and that's true of all parts of life. Most importantly, we're going to ask the question, is credit spread trading for you? Okay, what is a credit spread or an Iron Condor? A lot of you might know this, but we want to make sure that everybody's on the same page as we move forward. A credit spread is a combination of a long option and a short option. Now, the seller of an option or a short option is a strategy in which you collect a premium and you keep it if a certain event does not occur. It's kind of like insurance. When you pay your insurance premium, you're paying it hoping that nothing actually happens and the policy pays back your premium plus additional damages. So in other words, the idea of selling option is you're collecting a premium and you're hoping that a certain event doesn't occur. An option buyer is kind of the opposite. They're protecting themselves from a catastrophic risk. It might be portfolio insurance. It might be you're long corn and you want to protect yourself, so you buy a put. You know, options are pretty versatile. They can be used for just about anything you can imagine. But the point is, an option buyer is looking for a particular event to occur. So they're speculating on a price movement with limited risk. Credit spreads are basically a combination of both. And we'll define what exactly I'm talking about here in a few slides. Basically, a credit spread is any combination of long and short options that involve the same type of option. For example, calls and puts. With the same underlying commodity, in which a trader receives more premium for the options sold than is paid for the options purchased. If you really think about it, this is a pretty broad definition. You know, you could be buying one call and selling 2 calls, and you could be selling 3 calls, or you might be buying a call, selling 3 calls, and then buying a call above it. All of those kind of fall into the definition of credit spread. But what we're going to talk about today is a one-by-one, the simplest spread there is. They're most commonly referred to as a bull put spread and a bear call spread. Another way to look at a credit spread is it's basically the idea of buying a long option with a distant strike price to ensure the risk of being wrong in a speculative short option. So primarily it's a premium collection strategy or a short option strategy, but instead of selling options naked, you're buying protection. In a nutshell, credit spread trading is basically option selling with insurance. Specifically, a bull put spread is the simultaneous sell of a put and then a purchase of a put underneath that put as your insurance. This type of strategy is bullish to neutral. It has limited risk and it has limited profit potential. Anytime you're selling options, whether they're naked or as a part of a spread, you're always going to have limited profit potential. But if you're selling options naked, you have unlimited risk. When you're doing a spread like this, you're basically saying, I'm not willing to take unlimited risk, so I'm going to cap my risk by purchasing insurance and see how things go from there. Now again, remember, I'll say it probably 100 times during this class, insurance is not free. Unfortunately, there's no easy way to collect premium and not have to worry about it. There's always going to be some sort of caveat. Okay, a bull put spread, the purpose of a bull put spread is for income, and it's a bullish speculation. However, you notice in the previous slide I said it was a bullish to neutral strategy, and that's true because if you're selling a bull put spread, preferably you want the market to go up. For example, let's just say you're selling a bull put spread under the S&P. You want the market to go higher because it takes all of the guessing out of it, it takes all of the stress out of it. If you sell a bull put spread and the market goes up, it's easy money. Of course, it doesn't always work that way, but the idea is that's the best case scenario. However, if you sell a bull put spread and the market trades sideways, you're still probably going to make money, because as the market is trading sideways and not making any progress in either direction, your options are eroding in value. And further, if you sell a bull put spread and the market moves down a little bit, you still could make money. So you could be wrong and still make money in this type of a strategy. Where you really get hurt is if you're extremely wrong. If you're extremely wrong, that's where the risk comes in. So this type of a strategy, just like if you've ever come to any of our other option trading classes in regards to selling naked options, spread trading is very similar in idea in that it's the type of strategy that you can make money whether you're right or wrong. It's just a matter of not being too wrong. And for full disclosure, the last 12 months or so have been pretty rough for a lot of option sellers, particularly in markets like crude oil, the grains, because we've seen markets that go from being really quiet for a week or so and then just from out of nowhere blow up in a volatility, and sometimes it's a little too much for option sellers to take, particularly crude that dropped 50% in a short period of time. Anybody trying to sell strangles or sell puts under the market had a really rough time. Unfortunately, those types of things happen, but it's it just comes with the territory at times. There's times where certain strategies work flawlessly, and then there's other times where it just seems like you can't catch a break, and that's true of trend traders or option sellers or option buyers. Markets go through cycles, and strategies go through times of feast and times of famine. So with all that said, in a bull put spread, you're basically taking your primary position as a short put, meaning you'd prefer the market to go up, but worst case scenario, you just don't want it to go down too much. And then you're buying a put underneath the put that you sold for insurance. This gives you absolute protection against catastrophic loss, assuming you hold everything to expiration. Here's an example of something that a trader might have done recently. A trader selling a crude oil 42 put is speculating that prices are going to stay above 42. So for those of you that have never done any option selling, the basic idea is if you sell a crude oil 42 put, you're basically betting that crude will stay above 42. You'll notice at this point in time the market is probably somewhere around 52. Oops, I'm not very good at drawing circles. Somewhere around 52, 53. So the idea is you can be wrong by $11 and still make money. As long as the market stays above this area at expiration, 42, you make the entire premium. Somebody selling a naked option would have made 65 cents. But somebody that maybe prefers to buy insurance, they want to sleep at night, they don't want to have to worry about all heck breaking loose, they might have bought a 37 put under the market for 25 cents. The net premium is $400 because you're collecting 650 bucks. By the way, each penny in crude oil is worth $10. So if you're collecting 65 cents, that's 650 bucks. And if you're paying 25 out for your insurance, that's $250. So you're collecting $400 for the spread. And it seems like pretty good odds. I mean, as long as the market doesn't fall below 42, which is $11 away from the market at the time of this chart the snapshot was taken, you make some money. Whoops. Sorry about that. Okay, so let's take a little closer look at how this might work out. The nice thing I mentioned before about credit spreads is that you have limited risk. No matter what happens, you know the worst case scenario. But the problem with credit spreads is sometimes that worst case scenario is pretty darn bad. In this particular instance, the maximum risk zone, which extends everywhere from, I'll just, roughly 37 down to infinity, or 0, I should say, is 4,600. So the most you can lose is 4,600, but geez, 4,600 is a lot of money, especially when the most you could ever make is $400. So the odds of success on a credit spread can be pretty good. I mean, like I said, we could be wrong by $11 and still make money on a trade like this. But the downside is, by the time you buy your insurance and everything else, you have a big risk and a small reward. Now, I'm not saying that that's a bad thing, because that's basically the whole idea of this type of a strategy. It's the same thing insurance companies do. Like I mentioned before, they collect premiums every month. Your car insurance is probably, who knows, in Vegas it's pretty high because we have a lot of drunk drivers, but it might be somewhere around $200 a month. $200 a month adds up quickly to the insurance company. For them, they make a pretty good living on it. And by the way, at the bottom of the slide, I have the equation of how do you figure out the break-even. Well, the break-even on a trade like this is the strike price of the short option minus the net premium collected. So you'll notice the break even on this trade is 41.60 because remember we collected 40 cents or $400. That 40 cents basically acts as a buffer. Once the futures price gets below 42, which is the strike price of our short option, we're giving our profits back until we essentially run out of money at 41.60. And then below 41.60, not only have we ran out of profits or ran out of cushion, we start losing money. And this is all based on at expiration. Option trading gets a little complicated because at any time before expiration, these mathematical equations really don't mean much. Option prices are valued based on human emotion, greed, volatility, all of these things that we can't really quantify. And so sometimes things get out of whack and markets get, they overreact and things get carried away. So just because at expiration we can calculate the risk and reward doesn't mean that that's how it's going to play out in real life. At any time before now and expiration, things can get pretty wild. Okay, let's take a look at the other scenario, a bear call spread. A bear call spread is the simultaneous sell of an out-of-the-money call, or if you're a real aggressive trader, you could even sell an at-the-money call or a little in-the-money call. But basically the idea is, in my opinion, you probably want to stay out of the money. So if you're selling a call option, it should be above the current market price, in my opinion. And the idea is, obviously, if you're selling a call, you want the market to preferably go down, but at least not go up. And it's a bearish to neutral strategy. The risk is limited because in a bear call spread, you're purchasing the insurance. Hypothetically, just so you understand what we're talking about here, if you buy if you sell an S&P, let's say 2150 call, and you purchase a 2200 call, that would be a bear call spread. You're selling the 2150 call as your primary position, but you want to insure it by buying the 2200 call. So in a bear call spread, the short call is the primary position. That's your money maker. That's what you're selling for income. And then the long call is your insurance, just in case you're real wrong. It's going to protect you against catastrophic losses. Now again, the losses can still be really big. It's just going to protect you against the ridiculous scenarios. For example, if anyone was trading the Swiss franc earlier this year, anyone that had short call options in that market without protection probably had a rough couple of days. And we're talking, within minutes, somebody could have easily lost 20, 30,000 in the blink of an eye. And that's not exaggerating. It was that wild of a move. Those types of things are rare. They don't happen very often. But you just be aware that sometimes markets get carried away. So that insurance does pay off every once in a while. Okay, let's take a look at a specific example. This does happen to be in the S&P. A bearish trader might opt to sell a 2140 call and purchase a 2180 call for insurance. Hypothetically, with this trade, the net credit would be around $9. Each point in the S&P is worth $50 for those of you that aren't familiar with the E-mini S&P. So if you collect $9 in premium, it's worth $450 to you. As long as the S&P stays below 2140, you keep your $450. Where you get in trouble is if the S&P rallies above 2140, and your max profit's your maximum risk is going to be if the market's trading above 2180. So remember, above 2140, you're giving back profits until you run out of the premium collected. And then once you reach the 2180 area, which is where you're buying your protection, it can't get any worse than that, but it's not, it's not good either. It's pretty unpleasant. Okay, this is the same trade, but just a different look at it. We're going to talk about profits and loss zones here again. Now on this trade, one thing that you'll learn as if you do start getting into option spreads is there's certain markets and certain scenarios in which the risk is just ginormous. I was going to say that's not really a word. Gigantic compared to your profit potential. And then there's other markets where you can actually put together a pretty nice trade as far as risk and reward. In my opinion, selling calls in the S&P can be one of those. The downfall is when you're selling calls in the S&P, you usually have to get closer to the market than a lot of traders like to do, because S&P calls just by nature are cheap. S&P puts are expensive and S&P calls are cheap. But the nice thing is they usually don't explode in value like the puts do either. You know, if S&P can have a pretty quick 20, 30, 40 point down day, but you don't see very many up days in that magnitude. And when you do, the options don't react as quickly on the calls as they do the puts on a down day. So with that said, a trader that sold the 2140 call and bought a 2180 call, they're facing a maximum risk of $1,500, which again, I'm not saying that's not a lot of money. It is, but you're collecting $450. The odds are pretty decent. Me personally, I'm bullish the S&P, so I'm not saying this is necessarily a good trade. I'm just saying this is an example of something you might structure, and it's not too bad. It's approximately 3-to-1 as an option spread. That's really not bad at all. You'll learn that. Obviously, when you're trading option spreads, when you're selling options, you're never going to get quite the risk-reward profile that a futures trader will get. But the difference is when you're selling options, in theory, you should make money on more trades than you lose. And as a futures trader, you know, some of the best traders in the world are only batting 50%. Or 500, I guess, is more appropriate. Okay, somebody's asking in the question area, how does one avoid stumbling over big players like Goldman? You know, I'm not sure that you really can. Obviously, we're a bunch of little fish in a big pond, and there's really not much we can do as far as that. I can tell you that a lot of the big banks, like Goldman and some of the others, have really scaled down on their S&P trading. In fact, if you would have asked me this a year or two ago, I would have told you that most of them are still executing in the open outcry pits using the big S&P. Now they've kind of closed down their desks and they're trading electronically, so there's really, you know, we just have no way of knowing who and when and how many people are buying or selling at this point. All we can do is go off of the screen, the dome panels, and, you know, make guesses. And I'm not sure, you know, even if we knew what Goldman was doing, if it would give us any sort of benefit or disadvantage other than, you know, they're probably better than we are, and we'll just have to leave it at that. Okay, an Iron Condor, just for informational purposes, is basically when you're trading credit spreads on both sides of the market. It's a simultaneous holding of a bear call spread and a bull put spread. This type of strategy is absolutely neutral. You don't have any directional bias whatsoever. You want the market to go nowhere is the perfect scenario. There's limited risk and there's limited profit potential. But the idea of this type of a trade, it's basically a short option strangle with insurance, is you don't care if the market goes up, down, or sideways. As long as the volatility stays at a reasonable level, you should do okay. Here's what a chart or a payout diagram might look on with a Condor. Again, your max profit is the premium that you collect. Your max loss is going to be the premium collected minus the difference in strike prices. But the beauty of a strangle or an Iron Condor like this is you only have risk on one side of the market. So you potentially could make money on both sides. You could make money on the calls and you could make money on the puts. But it's impossible for you to lose on both sides. So it gives you a little better odds of success. Also, it shifts your break-even point out because the money that you're collecting on the put spread is helping to buffer your risk on the call spread and vice versa. And let's face it, most of the time, although the last couple of years, things have been a little weird with the Fed intervention and all these crazy things going on in the markets, but generally, the rule of thumb is markets spend 80% of the time trading in a range and 20% of the time making new ranges. So under normal circumstances, a strangle or an iron condor like this would probably face pretty good odds. Like I mentioned, in the last 12 months, I'm not sure that strangle traders have really had too much success, particularly in markets we've already mentioned, the grains and crude, just because we've seen some pretty massive moves in short periods of time, and it's hard for option sellers to keep up with that sometimes. Okay, let's talk about a different type of credit spread. Let's talk about calendar spreads. A calendar option spread, sometimes called a horizontal spread, consists of the sale of an option at one expiration month and the purchase of the same type of option in another or differing expiration month. For instance, if you're a gold trader, you might sell a June gold put, and then you might buy a May gold put to protect it, or vice versa. This strategy can get very complicated, and it's subject to a lot of guesswork when determining profit, loss, and risk. In the previous examples, we were able to calculate with exact science what your risk would be at expiration. When you're talking about calendar spreads, there is no such calculation. I mean, you can do the math, but the problem is it's never going to be accurate unless you just happen to guess correct, or none of the other variables change, such as volatility or demand or human emotion, those types of things. And also, options with different expiration months, a lot of times they'll behave differently. Sometimes, depending on the commodity, it's because the front month fundamentals are a little different than the back month fundamentals, or it just might be that a big hedge fund has a position in the front month and they have to get out before the contract expires, and you see a massive short squeeze. So sometimes it's just as simple as that. It has nothing to do with fundamentals or seasonals or anything of logic. It just, there's a big trader, he needs to get out and he moves the market in one contract month but not the other. The key to doing calendar spreads and really understanding where your risk is and what's going on is just knowing that options with less time to expiration erode more quickly. So in other words, if you're trading March options against June options, the March options are going to erode quicker than the June. And even knowing that doesn't give you any, obviously, special edge. It's just something you really need to keep in mind when you start putting these trades together. Let's take a look at an example. Okay, if you sell, these numbers obviously are not accurate. They're just for demonstration purposes. They were pretty accurate a few weeks ago. But anyway, if you sell a May gold 1150 put at $10, which in gold terms is equivalent to $1,000. Each dollar in gold is worth $100 to a trader. So if you sell an 1150 put for $10 and then you buy a June gold, see, we're selling May and we're buying June, so we're selling the front month, buying the back month, 1100 put, and you'll notice the 1100 put obviously has a lower strike price than the May 1150. So we're buying the June at $650. The net credit is $350. Well, the idea of this trade is that we're hoping that the May put erodes faster than the June. And it probably will. Under normal circumstances, that's how things work out. And at the time, we looked at the theta. The theta is basically the pace of premium erosion due to time going by. According to the numbers or the calculation and the theta, the erosion in the May could be as much as twice as fast as the June. The theta in May was 30 and the theta in June was approximately 15. Now, before you get too excited about using those types of projections, It's just a snapshot. That's the mathematical formula based on one day's market trade, but things can change fast. So just because it's that one day doesn't mean that that's how it's going to play out. And also, that's assuming that all else remains equal. If the market trades sideways, gold futures do not move, then it's very possible you see the options erode at that pace that the theta's spitting out. But more often than not, gold moves up or gold moves down, and guess what? The theta that you saw yesterday means nothing today. So don't get too caught up in those types of things. But assuming that it did, let's say that everything worked out and the May option eroded about twice as fast as the June gold option. At that point, when the May option expires, the June option is probably still going to be worth about $300 or $3 in premium. The net profit on that trade would be somewhere around $7 if the May option expired worthless. And again, this is all just an estimate because we have no idea what the volatility is going to be like. We don't know what the June option is going to be like. We know if the May option expires worthless, it's worthless, but we don't know what the June option is going to look like. That's the problem. That's why we can't accurately determine what the risk and reward might be. So these types of calendar spreads, they're really nothing more than theory, and there's plenty that can go wrong. Again, we'll mention it one more time. A change in volatility, a change in market direction, a change in market sentiment, all of these types of things can really wreak havoc on ideas that you thought were great calendar spreads. And one thing to really keep in mind is if the price of gold drops below 1150 on very low volatility, what could happen is you might be losing money on your May gold put that you're short. In fact, under 1150, it's almost like being short the future. The way this trade's constructed, the long June 1100 put should protect you, but it doesn't always. If it's low volatility, you could be losing money pretty quickly on the May 1150, and your June 1100 might not even be budging. In fact, you might be losing money on that too. So it can get tricky. Another version of the calendar spread is to do the opposite. Basically sell the option with the distant expiration and buy the option with the closer expiration. For example, someone might sell a June gold 1150 put for $15 or $1,500 and then buy a May gold put with an 1130 strike for $650. The net credit on this trade is $850. It's quite a bit higher than the previous example, which I think the net credit was $350 or somewhere in that ballpark. This trader knows that the May option is going to erode more quickly, but he's betting on direction. So the only reason you'd put on a trade like this is if you think gold's going up and you're pretty confident about it. And the reason being that June gold 1150 put that you sold for $15, that's going to lose value a lot quicker than the May if the market rallies. Now this is confusing because if you're in the last example I told you the May was going to erode more quickly, but that was just in that example we were just talking about time value alone. We were assuming that the market price stayed stable. This time around, this trader is not assuming the market price is going to stay stable. He's not worried, or necessarily, I shouldn't say he's not worried, but he's not focused on time value erosion. He's just focused on a directional trade. He's bullish gold, and this is a way to play it with relatively high probability, as opposed to buying a futures contract. And if anyone has ever traded a full-size gold futures contract, they know that it can be pretty stressful. This is a less stressful way of playing the upside in gold, but it's a very directional position. And the reason it's directional is the delta on the distant option, or the June in this case, is typically higher. As the market rallies, the June option should lose more than the May. But again, this is all under normal circumstances, but there's lots of things that can interfere with calendar spreads, so they're not perfect by any means. Okay, let's talk about advantages of credit spreads, because there certainly are some advantages. First of all, The majority of options expire worthless. This has been suggested and proven through various sources, including the Chicago Mercantile Exchange. Depending on where you're reading or where you're looking, it could be as many as 85% of options expire worthless, or as few as 60 to 65. But the overall consensus is most of them do expire worthless. Thus, the odds favor option selling. But they absolutely do not guarantee profits, that's for sure. Credit spreads, as we mentioned, is just a form of option selling. So obviously an advantage of trading credit spreads as opposed to outright futures or long options is the fact that most options expire worthless. However, the reason a lot of traders are looking towards credit spreads nowadays as opposed to a couple years ago is because in recent years, even options that have ended up expiring worthless have experienced massive temporary price spikes. And that makes option selling pretty challenging. Anybody following the euro the last week or two, we went from consolidating for a few weeks, pretty quiet trade, and then all of a sudden the euro dropped 6-7 cents against the dollar, and then it rallied 7-8 cents against the dollar. So anybody selling options out there really has to be extremely careful, and it gives them a little more incentive to trade credit spreads with protection as opposed to just going at it naked. Also, obviously, an advantage of selling options naked or trading credit spreads is time is on your side. Every minute that passes diminishes the value of a spread or an option. And this is just kind of giving you an idea of how option decay works. If you notice, I believe this is crude oil. This is a ways back, but anyway. If you notice, crude oil is trading relatively sideways, maybe a slightly bullish tilt. And as it's doing that, the value of this is actually a call option. The value of this call option is doing nothing but declining. There's some price spikes here and there, obviously. It's not a perfect straight line, but you can obviously see it's losing value even as the market's really not going anywhere. So that is the advantage of option selling. Okay. Probably the biggest advantage of credit spread trading is the reduced margin requirements. We'll give you an idea of how much of a reduction you get for buying that extra insurance. A trader could sell a June gold 1150 put naked for about $1,500, $1,550, and the margin requirement would be $2,400, roughly. These are rounded. Not too bad as far as margin to equity goes, or margin to premium goes. But the same trader could purchase the June 1100 put for $650 and basically cut their margin requirement in a third. The margin on the spread, selling the 1150 put and buying the 1150, selling the 1150 put and buying the 1100 put as a spread, the margin is only $886. So what happens is a lot of spread traders say, hey, I can sell 3 spreads and collect $2,700 in premium for the same margin it would take me to sell 1 naked. So obviously that's an advantage in some ways. However, you want to be careful with that because if you have 3 spreads, you have almost 3 times the risk. Sure, you're limited and you have your insurance, but as we've seen in a few examples, the risk can be really big. So you want to be real careful with that. In my opinion, in many cases, you're better off just selling one option naked further from the market, in other words, with a lower strike price than you are selling 3 spreads. Another advantage of credit spreads is the reduced position volatility. If you're not familiar with delta, it's basically the pace of price movement in an option relative to the price changes in the underlying futures contract. It basically measures volatility. So for example, if you have an option that has a delta of 50%, as the futures contract moves 1 point, your option would move half of a point. Credit spreads by nature have a relatively lower delta because the short option delta is reduced by the long option delta. Thus, a lower delta means lower volatility and a more comfortable trade. But what it also does is it means traders basically have to hang on for the long haul. When your spread don't really have that luxury because they're hedged for them. So they typically have to hang on for weeks to squeeze out their profit, assuming that they have one. Okay, this I just wanted to kind of show you how the position delta worked. In this example, we were selling an 1150 put here and buying the 1100 put in gold. The delta on the 1150 put is about 27, we'll just say 27%. So if gold drops $1, this option in theory, it's never as perfect as it should be, but in theory this option should gain in value by 27 cents on the dollar. And this option should gain in value by 13 cents on the dollar. So basically you're netting them. Your delta is netted. The position delta is now going to be about half of what it would be if you just sold the option naked. And here's the math. Your position delta on that particular trade would be somewhere around 14 versus 27 for an outright short call without the insurance. And again, we mentioned lower position volatility means lower delta means lower position volatility, and of course it's just more comfortable. Now, again, I just want to warn you, if you're the type of person that likes to take advantage of the discounted margins that spread traders receive, you want to be careful not to double up or triple up because you're kind of defeating the purpose. For example, the position delta on a one lot we mentioned was basically cut in half. It's now 14. But if you're going to sell 3 spreads, because you can sell 3 spreads for every 1 naked in regards to margin, your delta is going to jump up quite a bit. You want to be careful not to have too much risk on. Sometimes the illusion of safety that the protection offers is not quite as exciting as you think it might be. It's not going to help you nearly as much as you want it to if something goes wrong. Just something to keep in mind about delta and probability. I know a lot of people love the fancy option calculators and the platforms that'll tell them what the probability is of a certain option expiring worthless. And those are fun. We look at those also. But maybe a simpler way to do it, maybe not quite as accurate, but pretty close. When you're talking of options and this sort of thing, honestly, a percentage point is nothing because in reality, it's just going to change tomorrow when market environments and the news changes and that sort of thing. But anyway, you can use delta as kind of a cheap and easy way to find probability. So if a delta is 27, that roughly means the option has about a 27% probability of expiring worthless. And now if you're trading a spread, just because you have a lower delta, remember in the last example our delta was about 14, that doesn't mean that that spread has a 14% chance of expiring in the money. You know what, I'm sorry, there's an error in this slide. 27 delta suggests that there's a 27% probability of that expiring in the money, not worthless. I apologize for that. So obviously if there's a 27% chance of it expiring in the money, there's approximately a 70% chance it's going to expire worthless. That sounds a little better. All right. And so as far as your spread trades go, if your delta is 14, that doesn't necessarily mean that there's an 85% chance of the spread expiring worthless. What it does mean is there's a 14% chance that you will not see the maximum loss. In other words, there's an 85% chance that you won't see the maximum loss on your trade, but there's still going to be a 70% chance of your primary option expiring worthless. And so in other words, when you're talking about probabilities, go off the primary position, not the protective position. Okay, and we're gonna reiterate that the primary advantage of a credit spread is limited risk. And that's fabulous because you know exactly what the worst case scenario is no matter what happens. But it should be looked at as catastrophic insurance. It's really not going to do you much good at all on casual ebb and flow in the market. It's only going to protect you on those really big nasty moves that might have done quite a bit of harm to your account. And you'll be glad that you had it if you see something like that. The total risk on a credit spread is the distance between the strike prices minus the net premium. So we're talking about the premium collected for the short option minus the premium paid for the long option. So whatever your net premium collected was is going to be subtracted from the distance between the strike prices. If you're talking about crude oil, it can be very big. If you're collecting $500 for a spread, but your long option and your short option are $5 apart, we're talking a $4,500 risk. So it can be really large. So in other words, limited risk does not always mean less risk. Risk limits can be very large to premium collected. So you want to be, again, just understand what we're dealing with here. Just because you have protection doesn't mean it's going to save you from taking a big hit. It's just going to take you, it might save you from blowing out your entire account. It's a catastrophic loss insurance. And this is kind of just giving you an idea, reiterating what we've already talked about. But this is an example. If you sell an 1150 and you buy an 1100 put in gold, you're collecting approximately $9, but your risk is between 1150 and 1100. That's $5,000. So your total risk is $4,100. I don't know about you, but that's, in my opinion, a lot to risk on that type of a trade. So again, less risk doesn't always, limited risk does not always mean less risk. So just know what you're talking about when you start getting into the stuff. Understand what your risks are before you put the trade on. So this is just the example we looked at written out. If you're collecting $1,550 for an option, you're paying $650 for your protection. Your net credit is $900. Your max loss is the difference between the strike prices, which is $1,150 and $1,100, minus what you collected. So you come out to $4,100. Let's talk about the opportunity cost of credit spread trading. Unfortunately, when it comes to premium collection, you have to kind of decide what's best for you. Would you rather be closer to the money and have protection, or would you rather be further from the money and go at it naked? And when I say naked, I'm just saying selling an option with no protection. Most credit spread traders tend to get closer to the fire. In other words, the option that they're selling has a strike price that's closer to the current market price than maybe it otherwise would be if they were selling naked. So the cost to insure a short option can be steep. Thus, credit spread traders are tempted to sell closer to the money options to mitigate the impact of purchasing insurance. If you remember the previous example where the trader sold an 1150 gold put and then bought an 1100 and collected approximately 900, the same trader could have sold an 1120 put naked, collected about 900, and had more room for error. That trader, instead of starting to lose money or at least getting into danger when the market hits 1150, his risk is now below 1120. So it gives him $30 more in room for error. Another opportunity cost of credit spread trading is the tendency to overload risk. And we mentioned this already, but I want to make sure you understand. The margin discounts for credit spread traders they basically entice people to overload an account. For example, in the previous, we'll just kind of round our figures, by the way, but in the previous example, somebody might have had a risk of somewhere between $4,100 to $4,500 with a margin of anywhere between $1,000 and $1,500. So in theory, a trader possibly could execute 10 gold spreads in an account with $10,000, a $10,000 account, but the risk on those trades could be well into the $40,000 to $50,000 area. So even though the risk is limited, it could be limited to quadruple or more their account size. A sharp explosion in volatility could easily wipe out an account that's doing that sort of thing. I've seen, I talk to people and work with people all the time, and I've seen any strategy under the sun. I've seen good, the bad, and everything else. But one thing that I can for certain tell you is that somebody trading, loading 100% of their accounts with credit spreads, they might make money for a year, maybe even 2 years, but it's going to take one day, and they'll blow the entire account out just simply because of this right here. They have a lot of risk on the table. It's limited and it's hedged, but it's still very heavy. And it's just a matter of time before something bad happens and takes all the hard work that you did over the last year or two, and that's that. So just be aware. All right, another opportunity cost is insurance is not free. It eats the potential profits. I mean, not like anything else in our life, right? Car insurance, life insurance are all expensive. Trading's no different. Most of the premium that's paid for protection will be unnecessary. More often than not, when you sell a credit spread, that long option is going to lose you money. It's going to be frustrating, but if you are in a situation where you really needed that insurance, you just get caught up in a huge move, you're going to be glad you had it. So, I'm leaving it up to you. I'm just giving you the information. In my opinion, I prefer to sell naked. Sometimes it works out better that way, sometimes it doesn't. But yet again, you have to find what's going to be kosher to your personality, not mine or not your brokers or not your friends. It has to work for you. And you have to be comfortable. If you're uncomfortable, you're going to make bad decisions. And it doesn't take very many bad decisions to really wreak havoc on your account. Another frustrating thing about credit spread trading is the time value erosion occurs on the protective long option. So ideally, as an option seller, obviously you want time value to erode, and that's the whole idea of the strategy. However, as much as you're going to love seeing the erosion on your primary position, it's going to be frustrating to see it on your protective position. It can be highly counterproductive. I've seen, and especially if you're selling options that have a lot of time left on them, and when I say a lot, I'm talking 6 months, 5 months, anything more than 60 days, I would say. What you'll find is with the credit spreads, you have a lot of risk and very little reward because both options will be slowly eroding at approximately the same pace. So you're not really getting a lot of benefit. I mean, you'll squeeze out a few bucks here and there, but you're not going to see much profit potential with option spreads that have that much time on them. However, if something happens and the market starts moving and volatility picks up, you could really, really feel the sting from it. So it's all risk, very little reward. In a typical credit spread, the short option, because it's closer to the money, is more volatile, yet the long option erodes at a quicker pace. Thus, the long option provides less of a hedge than is desired. It's basically going to eat up your profits dramatically. However, again, it's there for catastrophic insurance. In the rare, highly volatile conditions, it's going to come in handy. But more often than not, it's going to be very frustrating to see your protective option do more damage than it is good time in and time out. Okay, let's talk about the real risk of credit spread trading. We're just going to reiterate some of the things we've talked about and add a little something extra. Limited risk does not equal less risk. Credit spreads enable traders to define the absolute worst case scenario, but that doesn't mean that scenario is not devastating. I just mentioned before a gold trader that tries to squeeze 9 or 10 spreads into a $10,000 account could very easily blow out their account in a very short period of time. That trader had limited risk, but it was still a very substantial risk. If trading credit spreads means selling more dangerous options, for example, closer to the money or in higher quantities, it's probably far more risky than it is just selling them naked. And I know you hear all the time the horror stories of naked option selling, and trust me, crazy things happen and it can be rough, but it's not unlike any other strategy. Anyone that trades futures will tell you the same thing. Anyone that buys options as a strategy, they go sometimes, months or years without a winning trade. Maybe not years, I shouldn't say that, but it's really hard to make money buying options because your timing has to be almost perfect. So as many downfalls as naked option selling has, it's not like the other strategies don't have just as many downfalls. It's just a matter of finding what you can find to make work for you. But the bottom line is credit spread risk is often capped at levels that are much higher than most of us would be willing to risk on a short option anyway. Okay, so I'm going to answer a question that I saw pop up. Is it easier to adjust naked option positions or credit spread positions? In my opinion, it's easier to adjust naked options, and that's another reason why I tend to lean that way. And again, sometimes credit spreads work better, sometimes naked options work better. So it's not like I can with absolute certainty tell you that you should you should only be selling options naked, because again, it's just not for everybody. But the one benefit of selling options naked is they're really easy to get in and out of. You don't have to worry about multiple legs, things like that, and you can adjust them very easily. With credit spreads, it's a little tougher because if when you're going to adjust, for example, as a naked option seller, an adjustment might include buying back your current option and selling two higher. Like, for example, if you're taking heat on the call options, you might buy back your current call and sell two deep out of the money calls to kind of recoup the premium and see how things work out. If you're selling a spread, you have to decide if you want to keep the long option that you have protecting yourself and just kind of trade around it and still use that as the insurance, or if you want to move the entire spread, and it just gets not only commission, but just the logistics of it get a little more complicated. Someone's asking if I'm going to show option chains for the futures. The few screenshots that I showed a little earlier with the option values, that actually was basically a cropped screenshot of my option screen with option chains. I don't have any live data going through at this point, particularly because it's aftermarket, but also just because I didn't prepare it and wasn't prepared for that. But so I'm not. But if you want to sign up for a demo, we have platforms where you could actually, log in and take a look at option chains and just get an idea of how things are moving around and how things work and what the premiums are. And there's margin calculators within the platform. So if you're interested in that, you can go to our website, decarleytrading.com, and go to the platform section. Or better yet, probably easier if you just send me an email and I'll give you the information. Somebody's asking, what do you think about using ETFs as proxies for futures as it perhaps pertains to less risk and less margin? To be 100% honest, I mean, I'm a commodity broker, so I'm not familiar with the margining on ETFs, and really I'm not an expert there. I trade them for my personal account as far as my retirement account, but beyond that, I'm really just not in tune with all that kind of stuff, so I'd hate to give you bad information. Somebody's asking, how do you defend a naked option? Some examples. It gets tricky, especially if you see massive price moves in the futures market in a short period of time. You might see option values. Honestly, there's some instances where the option market just it's almost like it's broken. The options are way overpriced because people just get excited or they're scared and they're panicked. So there's times where it's pretty tough to figure out what's the best course of action, and all you can do is try to spread your risk out and hope for the best. But something that we typically will do if we're taking some heat on an option is we'll basically just buy it back and replace it with a strangle. So, just purely hypothetically, if we're short a euro call and the market presses higher against it and it gets to a point where we're about double, so if we sell a call for 40 points and it's now worth 80, at that point we kind of say, hey, we're taking a little more heat than we want to here, maybe we should do something, and then we start shopping around for possible adjustments, and that would more often than not mean buying back the existing call and then just selling a call and a put to replace it. So if we're buying back our existing call for 80 ticks, we might sell a call worth 40 ticks and a put worth 40 ticks. And the idea of that is if there's a big explosion in volatility, usually options on both sides of the market are a little overpriced. And so if the market calms down and people realize it's not the end of the world, the options will a lot of times implode and lose value. And so that's what we're hoping for when we do that sort of an adjustment. Some traders opt, if you're trading multiple options at a time, some people like to buy or sell futures contracts against your options to give your, similar to kind of a covered call, but typically you'd want to do, one future per 3 or 4 options as opposed to 1-to-1, just because of the leverage in the futures can be pretty nasty. So there's lots of different ways to deal with it. But each scenario is different, and it's tricky because you never know until after the fact what's going to be the best way to go about it. Okay, somebody's asking, do you use deltas to set the strikes on Iron Condors? I mean, me personally, I look at delta, but I don't. It's not something that I am absolute about. Like, I know traders that their strategy is I'm only going to sell options with a 10% delta, or I'm only going to sell option spreads, with a 9% delta or 8%. And I honestly don't look at that quite as much as I look at the premium and the volatility. Like, if, for example, if I see an option or an option spread that's doubled in value in a day or two just because the volatility is increased, that's when I start to get interested. I don't, I look at deltas, but I don't really necessarily base my decision on them. I just look at the chart and I see where support resistance. I want to make sure if I'm selling a call, I'm above resistance. If I'm selling a put, I'm below it. I want to make sure it's worth my while. I want to make sure I'm selling an option that is on an upswing and not something that's been slowly eroding, because probably the most dangerous thing for option sellers is to sell options in a quiet market, because quiet markets never last. When it becomes not so quiet is when you can get into trouble. So we like to try to sell options into volatility. Of course, it always, anytime you're doing that, you're never going to pick the high on the spike in volatility. You're always going to take a little heat on the way in, but generally markets tend to come to their senses and relax, and when they do, the option prices relax. Somebody's asking if it's possible to construct an option spread instead of a commodity future spread. For example, if you want to buy July corn and sell December corn futures. You could do that with options. However, you'd probably have a very tough time making money, because if you, for example, if the spread was to buy the December corn and sell July, the profit potential on future spreads like that is usually pretty muted. It's usually not a big figure that you're shooting for as a spread trader. So when you factor in the premium that you would have to pay to buy like a December call and then buy a July put or whatever the case is with your spread, it probably would leave you with a position where you have limited risk and you wouldn't have to really worry about it too much, but the time value would eat you up, and just the fact that the market probably wouldn't move enough to give you any type of profit on it would be, probably just wouldn't be worth your while, to be honest. Okay, I'm going to start moving through the slides, and then I'll pick back up on some of these questions in just a few minutes. Okay, again, limited risk is not less risk, and this might be most true in the S&P put options. The S&P put options is a very popular product for credit spread traders and put sellers, and that's perfectly fine, but one thing you got to keep in mind is if you're going to sell put spreads in the S&P, your risk is going to be really, really wide relative to the premium you collect, and that's because, you know, I mentioned before, S&P puts just tend to be pricey, and S&P calls tend to be cheap. It just is how it is, because markets, you know, you've heard it, they go up the stairs, but then they go down the elevator, and it's true. When they go down a lot faster than they go up. Thus, the puts are more expensive. So, for example, somebody that looking to sell a December 1550 put in the S&P might get 12 bucks. And it would cost them $7 to buy the 1500 put. The net credit would be 250 bucks before commission. That's the most you could ever make no matter what happens, is $250 before transaction costs. The total margin on the trade would only be about 680, 700 bucks, so it's not too bad. But I mean, if you think about it, you're only collecting 250 bucks, so it's not like it's that attractive, and we're talking about a December expiration, so it has quite a bit of time. The reason I have this example here is I want to point out how big the risk can be. You're only collecting $250, but the max risk on the trade is the difference between 1550 and 1500, which is 50 S&P points, minus what you collected. So in a nutshell, it ends up being about $2,250. Not accounting for transaction fees. That's 10 times the premium you collected. So I'm pretty sure most of us wouldn't be interested in risking $2,250 to possibly make 250 bucks. Now, the argument that traders will make on this is the odds of the S&P getting down to 1550 are probably not that great, but it could happen, and honestly, it doesn't necessarily have to happen. If the S&P gets down to 1700, these options will probably be insanely overpriced. So in my opinion, if you're going to sell S&P puts, I tend to think, I hate to say this, but I think maybe selling naked puts against some volatility might be a better bet than credit spread trading. Or if you do want to have the insurance, I don't blame the S&P can move to the downside pretty quick, but you might want to do possibly a 2-to-1 or a 3-to-1. So for example, if you're selling two options, you might buy one protection. That way you give yourself a reasonable chance to make money for the risk that you're taking on. Just to give you an idea, the same trader could have sold a 1450 put naked for $5 and a margin of $1,000. So they're paying a little more margin, and yes, their risk is unlimited, but they're selling a put that's 100 S&P points lower. That's a lot. I mean, sometimes the S&P doesn't move 100 points in a month or two. Well, usually it doesn't move 100 points. But I mean, you get the idea. 100 points is a lot. That's like a lifetime. and room for error. Okay, what are the best environments for credit spread trading? Well, in my opinion, if you're going to trade credit spreads, you want to try to stick to under 45 days, maybe even preferably less than 30 days. And this is because, again, the time value of the option erodes quickest in the last 30 days of an option life. So if you're long an option, you want to make sure your short option is eroding quick enough to make up for the losses on your long option. And it's easier to do this with less timed expiration than it is with more timed expiration. As we mentioned before, spreads with lots of time on them tend to be all risk and no reward. Some of the best markets to trade credit spreads in, I mean, again, this is all situational, depends on the environment, what the volatility is like, but Treasury bonds and notes are pretty popular. Crude oil is popular for spread traders and currencies. Also the grains, a lot of people, because of the liquidity in corn and not so much soybeans, but maybe wheat, tend to do these types of credit spreads. You're probably looking at quite a bit less premium collected in corn and wheat, but the margins are also very low. So they're also candidates. Those that you want to be weary of, and I'm not saying don't do it, just be a little more careful of them and understand the nature of the market, is those that see high implied volatility in the deep out of the money options typically aren't the best places for credit spread trading, but again, it's all situational. So S&P puts we talked about, and also gold calls. It's kind of the same thing, you know, the opposite of the S&P. Gold calls are the ones that get pretty expensive, and the puts tend to be a little cheaper, even though gold's on a little bit of a downdraft here the last year or so. That will still be the case. If gold starts to rally, trust me, the calls will pick up in value like nothing you've ever seen. That's just how gold is. So be aware of market tendencies and just trade accordingly. Well, is credit spread trading for you? It might be if you wake up in the middle of the night to babysit short option trades. You know, if you're worried about a short option position, a naked short option position, then you probably should have credit spreads on. If you're waking up in the middle of the night, you know, the lack of sleep is going to take a toll on emotions, decisions, and your trading account. If you're left-brained and you must be able to mathematically quantify your risk at all times, you should probably be trading credit spreads. I mean, not everybody's equipped to mentally cope with the idea of unlimited risk, and that's okay. Also, if your risk capital is limited to the funds deposited in your trading account, you probably should be trading credit spreads. If you don't have the additional funds to risk in the case of a margin call or something worse, you probably should be purchasing insurance to prevent that from happening. Okay, I want to thank everybody for attending and remind you, if you're interested in learning more of what we have to say, you can pick up a copy of my books at any major outlet, but primarily Amazon is probably the cheapest and most convenient. Here's all my contact information. You can feel free to call me or shoot me an email at any time if you have any questions. And again, don't forget about our Facebook and Twitter page. The Twitter handle is @CarleyGarner. And I'm going to dive back into these questions.
All right. Thank you very much, Carley. So guys, if you have any last-minute questions, now's the time to ask.
Okay, somebody's asking if we're able to take Canadian clients in BC, and unfortunately the answer to that is no. Due to Canadian regulations, I would venture to say most U.S. brokerage firms are unable to accept Canadian clients at this time, but that could change in the future. Who knows? Somebody's asking, do we sell weekly options? I have clients that do a lot of weekly option trading. Me personally, with our recommendations, and we just haven't really gotten into selling of weekly options. I do think the weekly options are great for futures traders that are looking to kind of insure against, you know, their day trades or their swing trades, but we haven't really gotten into option selling on the weeklies. But again, I've got clients that do it, so it's not, you know, we have capability, it's just not something we've practiced. Okay. The question is, what hours are the futures options available for trading? Well, this is the great part relative to stocks and stock options. They're basically only available during, market hours, approximately 9 to 4, 8 to 4 in Chicago, whatever it is. Futures options, on the other hand, are available for the most part 24 hours a day. They do close for about 45 minutes in the afternoon. However, one thing to keep in mind is not all the futures markets, even though they're open, and I should say not all the futures on options markets, they might be open, but they might not necessarily be tradable. Some of the overnight markets, like for instance crude oil, there's not market makers in the overnight, so you could trade them if you wanted to. You could put an order in, but there's probably not somebody to take the other side. So unless you absolutely have to trade those particular markets in the overnight, you probably don't want to. You want to try to stick to the day session. But some of the markets that are a little more liquid in regards to the options, like the E-mini S&P, treasuries, they have market makers basically around the clock, so you can trade them in pretty good conditions almost 24 hours a day. In the case of the markets like crude oil that don't have overnight market makers, you can always trade the futures against your options. So even though the options might be thin in the overnight trade, you can always buy a mini contract or a full-size contract to hedge your short calls or whatever the case is. So you can always do something to protect your position if that's what you want to do. Okay, somebody's asking, isn't 2-to-1 credit spread a combination of both disadvantages of naked option and credit spread? And that's a good point. It is. It's also kind of taking advantage of the advantages of both strategies as well, but I can definitely see your point. The purpose of a 2-to-1 is it's basically somebody that would prefer to be naked, but just in case something really out of the ordinary happens, they want to take a little bit of the pinch off of the risk.
Okay, so I think there's not any other questions, right? So if anybody is watching the recording later and they do have a question, then the best way to reach Carley is right there on your screen, cgarner@dcarleytrading.com. Okay, thank you very much, Carley, and I'll see you back maybe a few more months for another webinar.
Okay, thanks everyone.
Thanks, guys. Bye.